Hello, welcome to our discussions on the impact of business decisions on the financial statements. In this session, we will try to understand a decision, an investment decision, that is acquisition of asset. Acquisition of asset will always result in one of the following effects. Either it will lead to decrease in cash, or increase in equity, or increase in liability. Because whenever there is a asset, there has to be corresponding source or reduction in other asset. Let us take an example and understand that. We have opening balance sheet. We say that this business has purchased shares for cash, purchased M shares and issued shares at par, and purchased X shares and issued 10% bonds. When this company purchased the shares for cash, there is a payment, and the payment is 20,000 cash outflow, and creation of asset happens. So in this case, asset has been acquired and a corresponding reduction in the cash took place. Whereas in the case of purchase of M shares, the another asset has been acquired, but here we did not make any payment because the company is not having any cash, but issued shares to the extent of 50,000. So the share capital will increase to the extent of 50, and there is a corresponding asset on the balance sheet. Purchase X shares, and the payment is made through the issue of 10% bonds. Now if you observe these three, the first one has resulted in reduction of cash, the second one has resulted in increase in capital, which leads to increase in equity, and the third one is a creation of a liability. So whenever there is an acquisition of asset, as we mentioned here, will either result in the decrease in cash, or creation of liability, or increase in the equity. So since there are no other transaction, none of these have any incomes and expenses, so there is no profit or loss, but the cash in hand will become zero because we have used the entire cash to purchase these shares, and cash in hand in the balance sheet will become zero accordingly. No change in the capital, so no change in the reserves, no change in the loans. So the total of the balance sheet, the total of the sources is 250,000, and the total of assets should also be 250,000. So acquisition of asset, which is the focus of this particular session, shows that a company can acquire the assets either by using the existing cash, or by creating liability, or by raising capital. The same effect can also be seen through the accounting equation. When we purchase the shares in the accounting equation, cash reduces and increase in Z shares happen, no change in the sources side. When we purchase M shares, the M share is an asset, and the creation of a new liability comes into picture. That is 10%, that is the increase in the capital. And whereas in the third one, we purchased the shares, but this time we created a liability called 10% bonds. So acquisition of asset in this case shares, 20,000, 30,000, 50,000 and 50,000 resulted in increase in capital by 50, decrease in cash by 20, and increase in liability by and that too in the form of bonds, that is 20,000, 50,000. So whenever we see any organization purchasing assets, we have to ask a question: how is this asset being purchased? Or in other words, how is the company financing that asset? By using existing cash, or by creating a liability, or through acquisition or issue of shares. So therefore, we say that in principle, acquisition of asset will result in decrease in cash, increase in equity, or increase in liability. Thank you very much.